Good afternoon, everyone, and thank you for joining us on the Q3 and 9-month FY2024 results conference call of Arvind Smartspaces Limited. We have with us today on the call Mr. Kamal Singhal, Managing Director and CEO, Mr. Ankit Jain, CFO, Chief Financial Officer, Mr. Avinash Suresh, Chief Operating Officer, Mr. Prakash Makwana, Company Secretary, and Mr. Vikram Rajput, Head Investor Relations. Please note that a copy of the disclosure is available on the investor sections of the website of Arvind Smartspaces Limited, as well as on the stock exchanges. Please do note that anything said on this call that reflects the outlook towards the future, which could be construed as a forward-looking statement, must be reviewed in conjunction with the risks that the company faces. I would like to now hand over the call to Mr. Kamal Singhal for his opening remarks. Over to you, sir. Thank you.
Thank you, and a very good morning to all of you, and welcome to the operating and financial performance review for Arvind Smartspaces ending third quarter of 23-24. I would just begin by sharing my thoughts on real estate environment and broad highlights for the quarter, and then we look forward to taking your questions and suggestions. The macroeconomic tailwinds are continuing. In the fiscal year 24, India is poised to achieve a growth rate of around 7%, continuing a trend of strong economic performance since the onset of the pandemic. Multiple reports suggest that this growth trajectory will persist into financial year 25. Over the past decade, India has made significant investments in infrastructure, resulting into a remarkable 3.3-fold increase in public sector expenditure. This infusion of funds has not only bolstered the country's physical foundations, but also has laid the groundwork for sustained economic growth. Improved household financial well-being, increased job creation, declining unemployment rates, and advancement in education and healthcare metrics are all reflective of a concerted effort towards fostering broader-based prosperity. The surge in residential real estate activity has emerged as a significant contributor to India's economic narrative. Real estate sales have hit a decadal high, supported by a flurry of new property launches and corresponding uptick in sales across various urban centers. Despite price increases, the affordability ratios witnessed a marginal improvement in top 8 cities as income growth surpassed pricing growth and mortgage rates remain flat. Further, the demand buoyancy is being driven by end users, showcasing the underlying strength and stability of the housing cycle. At Arvind Smartspaces, we look forward to driving transformative growth in the residential real estate market. With consumer preferences evolving rapidly, we understand that staying relevant means continuously innovating. Our approach goes beyond mere construction. It's about crafting sustainable living solutions infused with technology and well-being, features tailored to demand of the modern era. With a robust customer-centric program, strong brand, expanding geographical footprint, innovative products, and commitment to operational excellence, we are poised to capitalize on emerging opportunities and deliver value to the customers and stakeholders alike. Coming to the operational update for the quarter and the 9 months, I am pleased to share some notable achievements. We have delivered record high 9-month sales value at 784 crores, an impressive 41% year-on-year growth, indicating strong consumer confidence and market demand. In the third quarter of FY24, our pre-sales value continued to show positive momentum at 280 crores, driven by successful launches of our premium projects such as Forest Trail in Sarjapur, Bangalore. This is a premium villa development where we achieved sales of more than 150 crores in Q3, which is little more than 30% of the launched inventory. The successful launch of Forest Trail, Sarjapur follows the stellar launch of Greatlands Phase 2 at Devanhalli and highlights the growing equity interest of the brand Arvind in our key markets of Bangalore. Following the remarkable response to Phase 1 of Uplands 2 in Adroda, Ahmedabad, we swiftly launched Phase 2, achieving a sales worth 75 crores there. We are delighted to have a strong response to all our new launches over the last several quarters in several different micro markets. Similarly, our Similarly to our 9 million bookings, collections for the 9 months, similar to our 9 months booking, collections for the 9 months period reached the highest levels in any given 9 months period. 9 months collections stood at 661 crores, a significant increase of 60% over the same period last year. Collections for the quarter increased by 16% year-on-year at 194 crores. This performance underscores our ability to maintain a strong operating cycle, aligning our sales, construction and delivery processes effectively. I'm pleased to note that our expansion initiatives have seen promising developments with a cumulative top-line potential addition of around 4,150 crores for the current financial year. Recently, we entered Surat with a rupees 1,100 crores horizontal multi-asset township project, expanding our presence in the third city in the state of Gujarat. The project is spread over 300 acres and signed under a JD model with 55% share accruing to us. This strategic move underscores our proactive approach to growth and our focus on seizing opportunities in emerging markets. We also added a new horizontal project in West Ahmedabad with a top-line potential of 250 crores. This would be on an outright basis. The quantum of JDAs in our portfolio is on a higher side currently, and we look forward to an optimal mix of JDAs and outright deals as we progress forward. Nevertheless, successful JDAs across markets showcase the confidence of landowners in Arvind brand, and this will allow us to build a strong, sustainable pipeline going forward. During the quarter, we achieved financial closure on Fruits of Life in a year and gave exit to HDFC Capital on the project. It not only highlights the brand equity and execution capabilities of brand Arvind, but also the thriving nature of horizontal and plotting projects and in the Ahmedabad market. The platform too continues to progress well, with the 3 projects already acquired under it across Ahmedabad and Bangalore. We look forward to acquire additional projects under this platform in our targeted markets in the coming quarters. Now moving on to operational side, in 9 months we reported a revenue of 224 crores, up 37% on year-on-year basis, and EBITDA grew at 68% to 57 crores. PAT for the 9 months grew 60% to 26 crores. In Q3, we reported a revenue of 84 crores, up 60% year-on-year basis, and EBITDA for Q3 grew by 60% as well to 21 crores. PAT for the quarter grew 121% to 9 crores. Our balance sheet position remains strong despite expanding operations. Net debt increased to negative 38 crores as on December 31st, 23, from a net debt position of 141 crores as on September 30th, 2023. A crucial parameter in real estate reflecting the underlying business performance quite well is operating cash flows, and during the quarter, net operating cash flows amounted to rupees 89 crores. Net operating cash flow during the 9 months stood at 360 crores. We estimate an unrealized operating cash flows exceeding 2,552 crores coming from the current pipeline of projects. As you would have noticed in our presentation, we have very recently relaunched our project at Odlapur in Bangalore. It's called Arvind Orchards. We look forward to deliver a differentiated experience to our customers in North Bangalore through this one-of-its-kind orchard-themed plotting development. To conclude, we see a very significant opportunity for the Indian real estate market, and Arvind Smartspaces is well poised to capitalize on the same and sustain its path of profitable growth. As we approach the financial year end, the objective remains to end it on a very strong note across operational and financial parameters. On that note, I conclude my opening remarks, and I would like to ask the moderator to open the line for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Biplab and from NT Stock Broking. Please go ahead.
Good afternoon, sir. So my first question would be on the business development front. Excellent velocity. So this 40 billion, around 40 billion GDP business development that you did till date in this financial year, when do you expect these projects to be launched? Can all of this could be launched in FY25?
Yeah, of course, yeah. I mean, 4,000 crores worth of new projects have been added in the last few quarters. And for this year, this is the cumulative number. And of course, this is planned to be launched in the coming year.
And one portion of 600 crores is already been launched.
Yeah, in fact, 600 crores out of this 4,000 plus crores is already launched. But in any case, rest of it should also be getting launched within this coming financial year.
Okay, so there is a quick turnaround time. It doesn't take much from business development to launch.
Yeah, so I mean, it's a combination of medium-sized and very large-sized projects which require environment clearance and projects which do not require environment clearances. But putting everything together, we see a very realistic possibility of everything of this getting launched within this financial year.
Okay. My second question is on the, Ahmedabad 40 acres that acquisition outright basis you did. Just trying to understand what would be the cost of the land that you have paid for that?
Normally, the specifics about the cost, etc., is not shared. Maybe you can get in touch with the team here to know to what extent it is prudent for us to share such data. I'm not sure about it. But otherwise, this is a great product from the margin standpoint, from the standpoint of making quicker money and hitting the market very, very soon. In fact, we are hoping that we hit market with this project, in next 2 weeks itself. So within this financial year, possibly we should be starting to sell this product. So it's a very quick turnaround project. And the rest possibly you can get in touch and we'll figure it out to what extent the information can be shared.
And in typically such projects, suppose you have bought the land. Okay, we keep aside that cost. But what would be the other cost and what would be quantum of that cost? Say for this 40 acres project, what would be the other cost and what would be the quantum of that cost that need to be incurred for this project?
So operating margins and EBITDAs in these projects vary anywhere between 25% to as high as 35-40%. Maybe average of a plotting project that we are currently executing will be more than 30-35%. And this project should be very similar to that. And that's how the costs are.
Okay. Thank you, sir.
Thank you. The next question is from the line of Ritvik Sheth from One Up Financial Consultants. Please go ahead.
Hi. Good afternoon, sir, and congratulations on excellent set of numbers. Sir,
can you talk a little louder, please? I mean, we're not able to hear you really.
Yeah, is this better?
Yeah, better, significantly better, yes.
Sorry. Yeah. Firstly, you mentioned that you are planning to launch the West Ahmedabad project, which you acquired recently in Q4 FY24 itself. Did I hear it right?
FY25, we said. I mean, when we talked about this 4,000 worth of projects, so what we said was this entire pipeline that we've acquired recently, which is totaling to 4,000 for this current year as a total.
Okay.
Everything of that will be launched in the coming financial year, which is 2024-25.
Okay, sure. Got it.
Lakshmanpura, this one project out of it,
right,
which is not a very big project, but otherwise a profitable one, will be launched within this financial year, hopefully.
Right, okay.
Within the current financial year ending March 24.
Got it. Okay. And so second question is on the HDFC platform. What is the total amount that we have deployed till date out of the 900 crores?
So we have committed in excess of 400 crores already from the platform. Maybe the payments are a little less than that, more like a 300-350 odd crores. But commitment-wise, it has crossed halfway, and we've deployed in that sense in excess of 400 crores.
Okay, great. And sir, just one question. We have 4,000 crores of launches to be done in the next 4-5 quarters. So what kind of business development are we looking this year? Already we have seen a very strong business development pipeline, the highest in the company's history. So, what will FY25 look like, and what would it be a similar number, around 4,000, 5,000 crores? Would like to pick your thoughts on that.
So, little futuristic, but as you very rightly said and understood that you already clocked in excess of 4,000 crores in the first 9 months of this year. Now, we would love and like and be happy with a number which is rounded off to something close to 5,000 crores for the year. And most of the projects which are in further discussions and pipeline, generally they are quite decent in size, and hence one or two happening will mean that we'll cross that number. So hopefully we cross that and do additional 1,000 odd crores within this financial year. But having said that, this trajectory of 4,000 to 5,000 crores is something that we hope that will sustain in the coming years as well. Right? It's not that this is an exceptional year and that's why it is high. It is a trajectory that we want to maintain.
Okay. Sure. And this acquisition would be more or less funded by internal accruals, HDFC platform, and debt if needs arise to be, right?
Correct. So, as you know, HDFC, there is a leftover still significant. Then internal accruals have been very strong. This year we've accumulated more than 360 odd crores, which is one of the highest, rather the highest ever. And company is still negative debt company as on December end. So hopefully, very, very conservatively, we should be raising debt to the extent of 300 to 400 crores. Even if it's 300, it is significant amount of money. So all in all these three engines are alive and kicking, and we should be able to make use of this.
Sure.
And on top of that, as of now, we are very, very heavy on JDs as a structure, and that is why a lot of money is still left to be deployed, despite adding a very significant top line of around 4,000 crores for the current year. To that extent, apart from deployment of these three sources, which are internal and external both put together, including the platform and debt, and of course internal approvals, JDs are kind of complementing and supplementing the other efforts towards creating bigger pipeline.
Right. And sir, just one final question, one clarification rather. The reported OCF of 360 crores in the quarter, that is for our company share, right? Net to us.
Yeah. So this quarter number is 90 crores, 89 crores to be more precise. This year's number is cumulative number for 9 months is 360 crores. And this is purely what has come to us already, and either it is already deployed or it's gone into any repayment at all. But yeah, this is purely our share accrued to us and received by us.
Okay, sir. So thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Abhishek from Yes Securities. Please go ahead.
Yeah, good afternoon, sir. Just one question. Where do we stand on the BD regarding to enter in MMR or say Pune or MMR cumulatively?
So if I have heard your question right, you are asking about BD efforts in Pune and MMR.
Yeah, sir, absolutely.
Correct. So yeah, those efforts are on. We have evaluated a bunch of projects. A couple of them are looking quite promising. They are in advanced stages as of now. We are a little conservative when it comes to adding a new geography, and that's how we are doing this time also. Surat, as you would recollect, was something that we started a few quarters back, and we continued that focus for a very long time, and eventually we come up with a very, very large, very good, exciting project there. We hope that with the kind of efforts going into MMR market, something should materialize very soon.
Within this financial year, or should it spill over to next year?
So, because, this is an entry point that you're talking about, and project happening and not happening is a little binary in that nature, and hence we can't say that it will happen, but, this quarter or next quarter, thereabouts, things should happen.
Sure. Second, just one more. We just acquired a small project in Ahmedabad. So, any color whether it will go to HDFC platform or we will execute it because it's an outright buy?
Yeah, so this project is taken on an outright basis. We are not involving platform in this. So whatever happens, the entire cash flows and margins, etc., go to us, and platform is not involved in this.
Okay. Thank you. That's all.
Thank you.
The next question is from the line of Ronald Sioni from Sharekhan Limited. Please go ahead.
Yeah, good afternoon, sir, and yeah, congratulations on your new business development deals for 9 months. So, sir, we had been pending around 700 to 750 crore of HDFC platform money here. So I believe some would have been utilized in Q3. Or if not, then how much has been outstanding? And, sir, are we using more of bent on leveraging our balance sheet and rather than not using HDFC money? Or if there is a possibility, that HDFC platform money would be used for, more larger transactions, especially in MMR region? Or so just your thought process on the usage of capital of your own and versus HDFC.
Sure. So the platform is sized at around 900 crores total, out of which 600 comes from SDFC and 300 is to be invested by us. And out of this 900 total, we have deployed to the tune of around 400 crores already, and 500 odd crores is still left to be deployed. Generally, it makes more sense for us to deploy this money in little long-term projects and projects which are of a little decent and bigger size and scale. For example, Lakshmanpura is not that size, and hence generally we would prefer not to invest in a Lakshmanpura kind of a project there. But having said that, money is available. If a project is viable, there is no problem and there is no hindrance to investing platform money or otherwise. As we just discussed, all the three sources, internal accruals, platform money and debt, all the three are available. At any given point in time, depending on the size of opportunity and the investments required, and that day, that week, that month's cash flows that we have on hand, obviously we would like to first exhaust internal accruals because that's our own money without any incremental costs, and then the cheaper money, and then the less cheaper money, etc. So that hierarchy is always followed. It has so happened that cash flows for the last few quarters have been strong. The last 3 quarters itself has given us in excess of 360 crores. To that extent, our leveraging has not really begun. We are still negative on the overall net debt side. At the same time, this has also resulted in underutilization of the platform money on a cumulative basis. But having said that, it's just a matter of time and a few more quarters before we get into a positive side of trajectory on both the net debt and utilization of the fund money.
And my second question would be, sir, as you also said that 300 to 400 crore debt might be raised for the next year. So already we are getting, big, larger size projects to JDs. So, leveraging the balance sheet, to get better margins, is that the thought process versus, JD projects would be there, but the mix would be lesser and outright would be higher. And last would be, on the margin front, like there is a little bit volatility in margins. And is it because, plotted projects had a lower revenue booking during the quarter and which had, led to sequential dip in margins?
So I'll ask Ankit to respond on the margin front. Ankit, will you please respond to that first and then I take it?
Sure. So margin, if you look at on a year-on-year basis, is for the quarter is same, which is 24.7%. These are adjusted margins for the interest element. So we have given this information in the information update. So hence our top line for the quarter is 60% growth and margin are equivalent to 60% growth. However, as a percentage of margin, these percentage of margin in financials do not reflect the current bookings because there is a lag in the accounting, the way accounting happens. So this relates to mainly projects which have been delivered and which were launched a couple of years back. Like, for example, the quarter relates to revenue recognition from Upland, Oasis. So the plotting projects booking which we are looking at, like Uplands 2.0 or maybe a forest trails which is there in the current quarter, which is more of pre-sales, does not come into books of accounts. Hope this clarifies.
Yeah, right. I understand that, but is because previous 3-4 years launch the project which has hit revenue recognition during this quarter, the mix of that would be higher towards or lower towards this plotted developments, and hence there is a little bit sequential volatility because last quarter their margins were very good. So
last quarter margins were higher. Again, it will vary on the revenue recognition projects. So
that's what he's saying, that depending on which projects are getting into the books of account, this volatility remains. But on an average, the margins otherwise are fairly consistent to the extent of around 25% of EBITDA, 11 to 12% of PAT. In fact, last quarter was, in my understanding, a little bit of an aberration where more profitable, disproportionately profitable projects entered into the books of account and hence this higher margin. This quarter, the current quarter, and the cumulative number in that sense is actually more representative of the profitability and the level of profitability that we expect in the normal course on a steady state basis.
And maybe just to add, your comment on plotting has a low margin. It is not a case that plotting is a low margin.
At least the other way around. Plotting is actually a little higher margin.
Yeah.
And the second part of your question related to more outright versus JDs, etc., etc. Yeah, I mean, generally we prefer to have a very optimal balanced portfolio from this point of view, structuring point of view. But it has so happened that in the first 9 months of this year, we've done more of JDs and less of outright. But because that has also meant that we have more investable money left as of now for the top line that we've already tied up, it will automatically be an orientation where we'll see more outright projects coming our way in the coming months from the money which is still left to be deployed.
Okay. Thank you very much, sir, and best of luck.
Thank you.
Thank you. The next question is from the line of Rakesh Wadhwani from Monarch AIF. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, in the initial remarks, you mentioned we work on the operating margin of 30 to 35% for the horizontal projects. Can you also give us what is the operating margin we work for the vertical projects?
So, I mean, weighted average of the two will be 25%, rather 25 to 30%. And I will say a long-term stabilized difference in operating margin will be to the extent of 5%. So if we are hovering anything between 25 to 30% as overall margins, then vertical would be more like 25%, 22% and thereabouts. And horizontal will be more like 30-35% or little more in a few cases, selected cases, and more like that. So, and hence the average of anything between 25 to 30%. You can assume that there is a difference of around 5% between the two on an average.
Okay, thank you. Sir, what will be the IRR we will be minimum looking with respect to the vertical or horizontal? Because if I look at horizontal, it should have more margin, more IRR.
Yeah, horizontal have more IRRs generally because the cash flows are better, they are more front-loaded, collection times are less, margins are healthy or decent or even better than vertical. So in that sense, all the three are adding up into one common understanding, which is higher IRRs. So definitely yes.
No, sir, my question is that what will be the IRR that we will be looking for in both the projects in order to take a project? For example, you are working on a new land development or thinking of a new land acquisition. So what is the minimum IRR level we will work, otherwise we will reject the project for the horizontal or vertical, if you can talk about that.
So generally 25% IRR is our broader understanding. It's not written in cast, but on an average we know that it has to be 25 and thereabouts. We have several projects, rather most of the projects which are a little better than that, but we are okay compromising a couple of percentage here and there. As a minimum average, it is around 25% for us.
Okay. Sir, and the projects that were launched in the last 1 or 2 quarters, like Uplands 2.0 and 3.0, Fruits of Life, which got full booking or 90% above booking in the first
quarter only, in the month of launch only, so that will have a higher IRR of 40-50% also.
Oh yes, I mean on top of that, these are JD projects, so the capital deployment is very less in any case. So we would have actually recovered a lot of money, most of money that we would have deployed on a net basis. So in these projects, IRRs are like so high that they are not relevant to be discussed in that sense. JD projects selling in 3-4 months, 5 months, giving you very hefty upfronted cash flows means IRRs are going to be very, very high. But that's because the way they are structured and if the sales velocity is simultaneously is good. So yeah, I mean the answer is yes.
Yes, thank you for that clarification. So now coming to the point of business development, what we have seen in the past, if I go before COVID, company had a more business from the horizontal. Slowly, gradually, the portfolio has shifting from horizontal to vertical. But if I look at the FY25 launches also on in the last few quarters, the company that they have done a land acquisition more towards horizontal. So just wanted to know land acquisition or business development strategy for FY25. Where do we see more land parcel will be added, whether in horizontal or vertical?
Yeah, it's a great question. As I said, more JDs have happened in the first 9 months, and JDs first tend to be little more horizontal than being vertical. But because we are left with quite a bit of money to be deployed in outright projects, as we just discussed a few minutes back, that will mean that more of horizontal will start entering into the portfolio very soon as we continue and deploy more money. But having said that, we have been quite happy and conscious about remaining a little more horizontal historically in the last 3-4 months and specifically post-COVID. In fact, we were the company who spotted this trend very early, and we saw benefits not only from the point of view of efficient allocation of capital, but also from the point of view of mitigating and minimizing risk, or rather optimizing risk in the portfolio, given the uncertainties we had during COVID and thereafter. So this strategy generally has paid off well. We don't see that we have penetrated deeper than what we should have been, we should be doing. And hence we see a lot of scope still left in the markets that we are in. For example, even Surat, a great city of the size of Ahmedabad, as big as Ahmedabad is, etc. But there are very few horizontal developments which are of that great quality, international standards, bringing a very different perspective to how a horizontal development can look like, etc. I mean, these are the kind of opportunities which are quite untapped. A lot of real estate developers have appreciated this. We spotted this trend a little early, and hence our portfolio today looks heavier on horizontal. Going forward also, we'll continue to keep similar pressure, similar kind of focus on horizontal. But having said, you will see quite a bit of action happening on vertical as well as we go ahead with deployment of the under-deployed money that we have from all the 3 sources we discussed.
Kamalji, if you can give some number, if we go for a 4,000 crore GDV value, what will be 60%? Will it be horizontal or 30% or 70%? Any thoughts you have in the mind? Because what I'm saying, you said you were early. Because what is my doubt is that to get such a land parcel, big land parcel, it will become difficult. Not maybe in FY25, FY26 or 26, getting big land parcel will be difficult. That is why I'm asking that.
So today we are optimizing. We've got both the options. As we invest and the way we've invested in the last few quarters, it doesn't mean that we have not got ideas and opportunities in vertical for that matter. It's about deploying in the best alternative at that day, looking at the possibility of sales, velocity of sales, etc. So to that extent, we are not overly worried about in what direction we will go, whether or not larger or these kind of parcels will be available. In fact, we've surprised ourselves already by getting into larger and larger horizontal arrangements and joint development agreements than what we were set out to be. And as the brand builds further, as the recognition happens further, it's already very strong in the markets that we are getting more and more opportunities in the market where landowners are approaching both for vertical and horizontal on joint development basis. And hence, this opportunity, in fact, when we talk about consolidation in the market, it essentially means that even if the market grows by 10%, the guys and the brands who are organized, etc., they are growing by 25%. And that means a lot of landowners now, instead of thinking of doing things themselves, want to go through the brand route, through an organized player route, and getting into development indirectly. If that is happening, the trend of JDs are only going to increase and consolidate further. To that extent, we are quite hopeful, and there are reasons to believe that these deals and these kind of deals will keep coming. But having said that, to keep a little fatter skin in the game, there has to be an optimum balance between JDs and our own projects, so that not only that we have better ratios in terms of profitability, return on equity, etc., we should also have skin which is better, which means return on effort have to be further optimized. And even in absolutes, for the effort that we put in as a portfolio are also healthy. So verticals which are owned by us are equally important. Our idea is to invest almost 50% of the money that we have, maybe 60% of the money goes into our own project, and 30 to 40% money goes into JDs. The 30-40% money going into JD means they will create disproportionate amount of top line, because they are more efficient on creating top line. To that extent, there will be a little bit of a orientation towards top line coming from JDs more. But from investment standpoint, it might be 60-40 in favor of vertical own projects versus JD.
Okay. Kamal, you have a few more questions. I'll come back. Yes.
Sorry to interrupt. May we request that you return to the question queue for follow-up questions?
Sure. Thank you.
Yeah. Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all participants in the conference, please limit your question to one per participant. Should you have a follow-up question, we request you to rejoin the queue. And the next question is from the line of Harsh Pathak from B&K Securities. Please go ahead.
Yes, hi. Thanks for the opportunity. Sir, I wanted to check. I mean, we have been hearing that, the major demand, 70% of the demand in real estate space come from the top 7-8 cities. But with regards to your recent foray in Surat, that's maybe you can say a tier 2 city. So how does this foray come in like our strategic growth map? What's our thought process? Maybe I'm looking from a medium-term strategic growth point of view.
Sure. You're talking in the context of Surat, right?
Yes, Surat and in general our foray in our tier 2 cities. Are we, looking like foray for similar forays in other cities, tier 2 cities as well, or will consolidate in this market? Any color that you can give?
Sure. So we have historically been a little conservative when it comes to geographical expansion and adding a new city. In the first almost 1 decade of our operations, we limited ourselves to Ahmedabad, Gandhinagar being a twin city, and Bangalore. And then we started thinking of city like Surat. In fact, we talked about Surat almost a year and a half back when we thought that this could be potentially a great opportunity for us. Quite a few things have happened since then in Surat, including the buses coming in and other activities, like bullet train becoming a reality very soon. Maybe by 26 we start seeing the train running through the city, etc. You'll be surprised that Surat actually is bigger than most of us believe. It's almost as big as Ahmedabad is on many fronts, including the number of houses sold, the size of the market, per capita income, overall scale and size, businesses, etc., including population. It's almost there. They are the same size. So it's a very natural fit. It might not be a tier 2 strategy for us in that sense typically, but we see Surat as a very natural extension. Whatever way we look at it, it could be seen as an extension of Ahmedabad, just a 3-hour drive from here, and very similar consumer mix, customer mix, brand recognition, etc. Almost the same size. And it can also be seen as a twin city to Mumbai, for example. Once bullet is ready, it's about 1.5 hours from Mumbai. So to that extent, it fits perfectly into the strategy overall. And we've spent enough and more time understanding the city, understanding the markets, and we've taken more time than what we would have ourselves anticipated to enter into the city, because we wanted to make sure that we enter with size, scale, and then the city should have potential to go deeper as we go forward. It's not about doing an opportunistic one or two projects. Once we enter, it has to be decent size, and that box also gets checked in this case. Other than that, we've said that in the medium term, Ahmedabad, Bangalore, obviously are home markets. Then MMR is our third priority, so to say. We have taken time before we announce something concrete in Mumbai, but Pune we already got going, and we hope that we'll add something there as well. So these three are going to be our medium-term focus, and Surat can be seen more like an extension of either Ahmedabad or Mumbai, whatever way you want to take it.
Sure. And any progress on the Mumbai market that you would want to highlight?
Mumbai, we are very intensely into the market at this point. We are not in a position to announce anything at this point in time, but the lens is becoming narrow and narrow. The focus is becoming narrower and narrower. Hopefully, in the coming quarter, we should be able to announce something there. But enough and more resources are already put. We are very, very closely monitoring and evaluating the market and specific possibilities. Hopefully, something should materialize soon. Surat is a great addition. We are happy that finally we've broken into the market, and once we reach there and we have a strong setup there, I'm sure this will give us a great opportunity to go deeper in a market which is as important as Ahmedabad for us.
Right, and just one last question. So when we say this, when we are nearing closure on the Mumbai market, so will it be an outright purchase or a JV? I'm asking more from a cash flow management perspective.
It could be both, but the way we are seeing at this point in time, it's looking more like a JD entry, where the initial fund deployment will be contained to a large extent. But we're open to both. We're evaluating both. I mean, going with the sheer numbers and the trend that I'm seeing from the option that we have evaluated of late, it seems that chances of a JD happening are higher than an outright happening.
Sure, sir. Thanks for answering my questions and all the best.
Thank you.
Thank you. The next question is from the line of Akshay Kothari from JHP Securities. Please go ahead.
Yeah, thanks for the opportunity. So congratulations on a very good pipeline. And it was exciting to see Arvind Smartspaces foraying in Surat. Just had one question. So what is the nearest village on NH48 where we have done the Surat thing?
This is still not disclosed, but this is close to that circle called, let me just figure it out. We can take the other question and I'll come back to you. I'm just forgetting the name of...
Is it near Kamraj?
I think so. That's the first, yeah, it's very near Kamraj. Yes, correct. You are right.
Okay, so again, then follow-upping on that, based on the indicative top line of 1,100 crores and 13 million square feet generation, the per square feet would be around 850 rupees per square feet, right?
So it will be more like a 7,000 to 8,000 rupees per square yard of realization on the land, yes.
Per var. So, okay, and this, what would be the size of the plot?
That we've not figured out yet. It's at a very early stage of planning and designing, etc., etc. I think those details will emerge over a period of time. We just got into an agreement and finalized the deal, etc., etc. But we'll come back. We'll share such details when we are close to the launch, etc. Anyway, as per the regulatory requirements, RERA, etc., we're supposed to be getting anything on the project before it is approved. So we'll wait for that information. But generally, we'll do what we keep doing at a place like Uplands or Atroda or stuff like that, or a mix of both.
And so just one last thing, just to get your thoughts on this. Surat is generally very famous for textiles and diamond market of lately. Now, the thing is, inherent nature of these businesses are that people have so much of cash that their second business is generally getting into real estate, because generally that is where money can be parked into. So we, being a company who doesn't indulge in all the activities, and how do you see this market actually evolving? Because today it's not there. In fact, the real estate players over there are the ones who actually are very much unorganized.
I get your point. So basically saying that what and how to handle the cash transactions, which might be a little more prevalent in a city like Surat, which is predominantly a business.
Yeah.
You're absolutely right. This challenge or this kind of additional aspect of the business existed in many cities that we did. For example, Ahmedabad itself to start with was very similar to that, and generally people believe that to sell a 15 crore villa in Ahmedabad in the outskirts with 100% check might not be a great idea. Our experience has been, in any market, the last 20% is neutral to this, or rather in favor of paying more check, which actually remains untapped to a very large extent because everybody takes the other color of money, which then means that there is nobody who gives 100% check. And if you are one of them, and if you are the only person doing that, it's an opportunity. Maybe it's a little smaller, but for one player to have this kind of vast market and a share of that vast market, I think it's big enough and deep enough for us to sustain and survive. The other thing is when it comes to buying a house, it's like something that you like, then you stretch yourself. If you don't like anyway, there are many reasons not to buy that. We've seen that wherever we delivered a great product, for example, uplands, irrespective of the values that were there at unit price levels, once people like it, to manage check is not that big an issue. Banks are funding. That means that even businessmen want to have little bigger size of their balance sheet these days. The overall environment is changing. Overall orientation is changing. And investing in house doesn't mean that you have to take the entire liquidity out of the system of your business. It broadly comes from bank if you so need it. And that's the cheapest source of money in any case. I'll give you one example. If you're buying a 10 crore house, you've got two options. One is to take that money from your business out, even if it is cash, but the cost of that capital, direct or indirect, cash or otherwise, has to be much more than what you could have otherwise managed through a bank. So even for a businessman who has a lot of cash and who keeps a lot of cash deployed in his business, he's always short of cash. I mean, that's how businesses work. And then to get into an asset which is appreciating, an asset he wants to enjoy, it's actually better, despite having cash, to take that money from the cheapest source, which is housing loan, and then deploy it, irrespective whether it is 10 crores or 15 crores. So all these combinations make a lot of sense. We haven't faced the kind of problem which looks like or appears to be from a periphery, and we've been able to sell quite a bit of these products at a very hefty pace. And of course, Bangalore and those kind of markets don't have this challenge at all. And Ahmedabad, we've cracked this already in multiple projects, multiple sizing, scales, etc., etc. So very, very hopeful and very, very reasonable to believe that, this is one aspect that we need to be careful about. But having said, if the right product is delivered, right product is planned, and right excitement is created, there shouldn't be a problem selling it.
Thank you. The next question is from the line of Rishikesh from Robo Capital. Please go ahead.
Hi. Thank you for the opportunity. So my first question is that we have around our ongoing unsold projects worth of around 1,400 crores if I have to see the operating cash flow table that we have prepared in our presentation. So I would like to know what kind of expected sales velocity do we see here now?
In the ongoing unsold projects you are saying?
Yes.
So generally, from the sales mix point of view, we see a trend of 1/3, 2/3 coming from sustenance and new launches. Broadly, this is what we possibly could be doing this year, and this is what we should be doing next year. And so does that answer your question, or you have some other part of the question to that?
No, so I wanted to mix this up with also the 4,000 crores GDV that we are planning for FY25. So what kind of velocity do we see for both of them? If you could provide it separately, for years of velocity that you see for unsold ones, ongoing projects, and the ones that you will be launching in FY25.
So the part one of the question, let me answer. So part one of the question is with respect to the completed and ongoing projects. It has increased significantly during this quarter, and it has, as you rightly pointed out, it has reached to close to 1,400 odd crores, mainly because of the two launches which we had. So we had one Forest Trail launch with the approximate sales value of 550 crores. out of which only 150 crores is sold. So hence 400 crores have got it added into the inventory of ongoing project. That is one. And number two is the phase 2 launch of Uplands 2.0, for which we have launched close to around 325 crores of inventory, and out of which 75 crores is sold. So the balance 250 odd crores gets added to the ongoing project inventory. So that's why you see an increase in the ongoing inventory number.
Okay, and this 1,400 in like how many years are you expecting to sell it off?
This comes into a sustainment phase, basically.
How much of that is...
How much we are going to sell out of this 1,400 crores in what time frame?
Sustainment sale, I mean, difficult to predict at this point in time, but we could say that in a couple of years' time, 2 to 3 years' time, everything should be on an ongoing basis getting liquidated. So last year we sold 800 total. This year we are hoping that we'll grow by 30% on fresh sales, and next year also we grow by 30%. That's the base target that we're keeping. I mean, building on that number, if that's how we are going in totality, and if one third of that is supposed to be coming from sustenance, I think I'll rather look at it from that point of view. And that way, it's very easy to crunch that number in that sense. So you can just plot the overall sales number first, which is starting from 800 in this year and the next year, and then assuming that 35% comes from sustenance of that. I think that's a better way to look at it rather than seeing, how and to what extent and what quantum will be sold from the 14-15 crores that we have right now. To that extent, you could analyze, because this is, sustenance also is an evolving number. We launched something today, Lakshmanpura. Maybe a couple of months is the launch phase, and thereafter it enters into the sustenance category in that sense. I mean, immediately after the first major launch. So we'll say that one third should come from sustenance on an ongoing basis, and overall number of sales how to predict and work.
Got your point. Also, just one last question. How do you see the revenue and EBITDA margins from a P&L accounting perspective for FY25 and FY26?
So, MIS sales is something that how they are appearing, and how it is happening. And books are obviously delayed by 2 to 3 years on an average. That's how the trajectory is. Generally, within a legitimate gap, the trajectory of growth that you see in your fresh sale should be also dovetailed with the trajectory of growth in the books of accounts. So if we say that we have been sort of consistently growing to the extent of 30-35% on fresh sales year on year, that should be the stabilized growth appearing in the books of accounts. So one way to look at it could be that you just assume that similar growth shall be visible in the books of account as well, which is more like a 25-30%. But one major disclosure or disclaimer in this is that it can really vary. On a comparatively smaller base of number of projects, etc., for the company like ours, it can vary from period to period because of that one trigger point when you formally say that this project is closed and this project is completed, OC received, etc., etc. Because of this one stop point, which is one button to be pressed, 1 day, 1 minute, this can vary. But on an average, long term, medium term, the growth trajectory will catch up with each other in both top line fresh versus what enters into books of accounts.
And we have 2,000 crores of...
And the other relevant factor in that is that as of now, as we speak, there is in excess of 2,000 crore worth of sales which has already happened, where the money is coming, going, development happening. So unrecognized revenue, which is actual sales but not yet reported or entered into books of account, is worth 2,000 crores as we speak. That's how you could take it, yeah. That is also one important handle for you to work on this number to predict what could happen in the books of account in at least next 2 to 3 years by when these projects are getting completed in any case.
Got your point, sir. Thank you very much.
Thank you.
Thank you.
The next question is from the line of Rishit Shah from Nuvama. Please go ahead.
Thank you for the opportunity, but my question has been answered. Thank you.
It's already answered, you said. Okay.
Thank you. The next question is from the line of Amit Jain, an individual investor. Please go ahead.
Thanks for the opportunity. I have a couple of questions. So the first question is, at the time of launch, what percentage of inventory do we ideally want?
So if I understood your question, right, you are saying what percentage of our inventory sold at the time of launch? Is that the question?
Yes. Launch to 6 months of time. Launch to 6 months. What percentage do you ideally want to sell off?
Okay, fair enough. So internally we would always target to sell in the first burst itself, maybe more like a month, 1.5, 2 months, at least 30%, 35% thereabouts. Because once we do that, we know that project is broadly in autopilot mode when it comes to money is required to execute. 35% is a very, very good number. And then you know that basically you don't need much of a money for your construction, and CF requirement goes to almost zero, if not exactly zero. That's how most of our projects are doing. As we speak, most of the projects are breaking even on the construction side and creating positive cash flows thereafter. So 30-35% is first milestone that we need to achieve, and that generally we tend to achieve sooner than 6 months. After the initial launch, within maybe 1 to 2 months or 3 months of launch, thereafter it's a sustenance phase. And every month you then tend to start, selling something like 2%, 1%, 3% every month and thereabouts, depending on the stage. We constantly, and for reasons which are identifiable, have been selling much more than the numbers that we just discussed in many of the projects we've sold in the recent past. But as management, as business people, we are happy selling 1/3 and thereabouts in the initial burst.
Sorry to interrupt, Amit. Your voice is not audible.
Not really.
No, so it's
Hello?
not audible. Yes, sir. Now it's audible.
No.
Again, it's breaking, so we can't.
No, not audible. Maybe we'll have to come back again.
Yes, please.
Sure. Okay.
Thank you. The next question is from the line of Rakesh Padwani from Monarch AIF. Please go ahead. Rakesh, sir, you can ask your question, please.
Hi, sir. Thank you for the follow-up opportunity. One last question from my side. How are you finding the land prices or the JV agreement shaping up in the future? Because now what we have seen in the last few quarters or last 1 or 2 years, the demand for real estate is very strong. That has led to land price increases, or the share that is asking by the JV partners are higher. So how are you seeing? Are you witnessing some same thing, and how are you trying to manage that?
So in general, yes, land prices have moved up across markets, across geographies, and outright deals are more expensive. That's the trend. But the good news is that such price hikes are broadly being taken care by the improved realizations, and hence margins, if at all, have got into very little pressure at this point in time. But having said, lands have become more expensive, and hence absolute values and the cost have gone up for the end product. But still, the demand and the sustainability of demand is quite widespread, and most of the inventory is being bought by people who are not big investors buying for speculation. These are long-term investments or long-term consumption sort of purposes that the buyers are buying the inventory for. So it's no big worry, and it's quite sustainable. What is the other question you had?
No, that is regarding that only. It's like, how are you negotiating with the JV partners for that? Like they are also...
JDs, especially on the larger land parcel, is quite subjective. People are looking at much more dependable, corporate, governed, and trustworthy people to partner with. There the competition actually is less than what we would have anticipated. And that basically is a function of track record versus the brand and the reliability, etc., etc. They're finding a good deal. In fact, it's more of we choosing rather than opportunities coming our way, because we have to create value, we have to create that destination, and these are long-term commitments, and generally these are LTVCs, long-term value creation projects. So there it's about us understanding the potential of the land more, and valuation generally is not that big a concern. Outright deals are a little more difficult because their price sensitivity there is high for both the parties, and generally the valuations have gone up on our outright deals.
Thank you, Kamalji. That was a great, that was a very helpful answers, very helpful. Best wishes to you and your team. Thank you.
Thank you. Thanks a lot.
Thank you. The last question is from the line of Deepak Purswani from Seven Investment. Please go ahead.
Yeah. Hi. Good afternoon, sir. Sir, just wanted to understand in terms of the launch pipeline for the next year. Since we have mentioned we have a inventory to be launched to the extent of 4,100 crore. Just wanted to get the sense, especially related to the two projects in terms of the approval process. One is NH48 Surat, which is recently launched. I mean, how should we look in terms of the approval for that project? And second is the Ahmedabad one, which is a NH47 South Ahmedabad one.
Sure. So great question. Both these are very large projects, and of course approval processes are a little longer than a vanilla medium-sized project or a small-sized project. To that extent, in the coming year, we'll be a little heavy on these launches in the second half of the year, and we are hoping that both these projects should be hitting the market in the real sense in the second half. And hence, in fact, first two quarters comparatively will be a little lighter on launches and will be significantly heavier on a planned basis in the second half. And both these should hit the market in the second half.
Okay. And so in terms of, also if you can also share in terms of our economic interest in the pre-sales numbers at the current juncture. For example, last year we did 800 odd crore, and this year we, looking at the trajectory, we may close at 1100 odd crore. So can you please share what would be our economic interest in this pre-sales?
We do share our economic interest project-wise. Against each of our projects, we have already put in one of the sheet in investor presentation our economic interest. You may refer that.
Thanks a lot.
Yeah, but just a reminder, I mean, these EBITDA numbers and the margin numbers that we report, this is after all other interest being taken care, landlords, share of land, JV shares, etc., etc. So whatever is reported from MIS standpoint or the project margin standpoint, etc., they're all the numbers which are post external interests.
Okay. Thank you. Thanks a lot, sir. And all the best.
Thank you.
Thank you. As that was the last question, I would now like to hand the conference over to management for closing comments.
Great. Thanks a lot, everybody, for participating in this earnings call of Arvind Smartspaces. And thanks again for your continued support on this. I hope we have been able to address most of your queries. However, if there is anything missed out on any of your questions, kindly reach out to Vikram, and he will connect with you offline and clarify and give further information as may be required. Looking forward to interacting with you, all of you, in the coming quarters. Thanks a lot. Thanks for your time.
Thank you. On behalf of